But besides integration, which is an internal thing, externally, the combined unit, is there any roadblock that you sense?
Not that I see. I mean, the biggest requirement to my mind will be funding, because the growth opportunities are huge. Funding today, fortunately, the bank has been very successful.
You know, one thing, and who better than you to answer this, because the combined bank will now have nearly 30% of your loan book coming from home loans. Do you see this share rising in future as the penetration gets deeper and deeper? And like you said, you know, it's the aspirational Indian. Everyone wants a bigger, better house.
In my view, yes, because the growth opportunity in housing in the coming years can be huge. If you look at the year ended March, HDFC's individual loan book grew 17%. Now, with that 17% growth that we had in the individual loan book was on the back of the fact that the loans sourced by HDFC Bank was only 30% of what we did. Now, can you imagine that if the entire bank platform of branches was available for distribution, which it now will be after the merger, then what kind of growth we can see? If you look at penetration, the bank has something like 7 crore customers or more, 70 million plus customers. Only 2% of those customers have taken housing loans from HDFC, only 2%. So look at the ability to cross-sell to the 98% who don't, of which 5 have taken loans from other banks. So it's a huge cross-selling opportunity.
Historically, you've grown at a run rate of 18 to 20% loan growth. You think in the years to come, that'll be the new normal, the line in sand?
In my sense, in my view, that should be there. It could even accelerate over time, but 18 to 20, to my mind, would be certainly the target the bank we had.
Right. You know, in 1990s, and this is what researchers and people who monitored your company back then have told me, that you set a clear target that you're going to improve your return ratios, or return on equity rather, by 100 basis points every year. You've managed to deliver that pretty much by far. But can that be the run rate going forward?
Very difficult to increase the return on equity by 100 basis points now. In those days, when we told investors we would do that in the 90s, it was doable. And we did it for almost 12, 13, 14 years. But at that time, the HDFC was not a financial conglomerate. We were a housing finance company largely. We had the bank, we had life insurance, we had just started life insurance, general insurance. But the amount of capital that we had invested in these companies was limited. So your return on equity is a function of your total capital and the returns you get. Capital that you put, for example, in insurance business in the early years does not generate returns straight away. It generates returns over a period of time. Probably first 8 years, 9 years, it does not generate return. That's one reason. The other reason is also that regulations now require larger amounts of capital to be retained in a bank than was the case in the 90s. So increasing return on equity by 100 basis points, to my mind, is very, very difficult. But in those days, what we told investors is 4 things. One is our return on equity will rise by 100 basis points a year. It did. That our cost-income ratio, we would bring it down to single digit, which we did. Third was that we would take no asset liability mismatch in our balance sheet, which you see consistently we've not been able to do. And the fourth thing we told investors at that time is that, we will focus on service and some of the soft issues.
You know, that's the other thing, and I must commend you for it. And we were chatting with a lot of people, as HDFC got ousted from the index, and HDFC Bank was one of the largest entities. And over the course of time, everyone has really lauded the group's ability to very clearly communicate with their shareholders and stakeholders, much as the clarity that you had in 90s, that, 100 basis points is the return that we're going to give you.
100 basis points increase a year.
Increase a year, yes. Do you have that kind of a target now for the combined entity?
Once the combined entity settles down, I'm sure the bank will put down certain targets on what they will aim at. The targets could be in terms of growth, it could be in terms of asset quality, but that is something which a bank will have to evolve once the integration process is completed in some respect, say over the next 1 or 2 quarters.
Sense on where it could be headed.
In terms of growth, of course, there will be targets in terms of growth. There'll be targets in terms of returns also. The bank's capital adequacy is high. They don't need capital for a long time. So therefore, they can sweat that equity and generate a higher return on equity in the coming years. But whether you can grow by 100 basis points a year, every year, year after year, to my mind, is a challenge.
No,
is a huge challenge.
Not. But there's got to be some range that you may be having.
So there will be a range the bank will have in terms of the return on equity, and a range the bank will have in terms of growth, and of course in terms of asset quality.